In 2012, Donald Trump reported a $48 million loan on his books. The only problem, that loan did not exist. It was fake. There were no agreements, no repayments, just a number on a balance sheet. And for many years, companies, both big and small, were able to use fake invoices and loans to move money tax-free. It was fairly simple. Just set up an offshore company, bill yourself for imaginary consulting services, and your tax burden shrinks. This all worked well in the pre-digital age until it didn't. Today, governments aren't just cracking down, they are auditing accounts, freezing assets, and slapping businesses with multiple figure fines. So what changed? And more importantly, what still works today? Well, in the next few minutes, I'm going to break down how fake invoicing used to operate, the landmines most people step on today, and what the rich do instead. Let's get into it. Everybody's heard of Enron, the poster child for cooking the books. A reputable company caught making up numbers, inflating stock prices, and wiping out billions overnight. But here's the truth. Every major company still does that to this day. They just use fancier names such as stock splits and payment shifting or strategic depreciation. Enron wasn't special. They just got sloppy paying their accountants well, which is why their firm, Arthur & Andersen, ratted them out. And the only real difference between back then and today is that small businesses could do it cheaply as well. Because back then, nothing was really digitized. So if a government was going to audit you, they would have to go and get your physical business books. And by then, you've done something egregious for them to be on your backs. And because of the internet boom at the time, so many new novel services appeared, which were very difficult to value. Who's to say how much your marketing gig online is going to be worth, whether $300 or $3,000? How much is your intellectual property valued, or the program that you use for your business, even though if it doesn't work that well? It's something similar to what we saw with cryptos. But back then, because banks were not sharing information between one another and tax authorities weren't getting that info automatically either, it was very easy to hide all of this in the background. But this all came crashing down after the 2007 UBS scandal. Swiss banks had always been a safe haven for Americans looking to shield their wealth from US taxes. But when UBS came under pressure, the Americans went on a global crusade to end offshore banking. Banks faced stricter regulations, common reporting standards, and FATCA were born. And tax havens were put under heavy fire because governments came up with a very simple solution to offshore loopholes: force companies to prove that they're real. Enter economic substance rules. If you're going to set up an offshore company and then bill your home country, the taxman's first question is, where's the business? They don't care about your fancy paperwork, they want actual proof. Substance, such as, does your offshore have an office? Local employees, an actual business presence. And no proof, no tax breaks. The transactions must be commercially justified. You can't just plow in your millions in profits into the Cayman Islands tax-free and expect your home country to be fine with it. And even if you do check all those boxes, you still have to deal with transfer pricing rules. These laws prevent businesses from inflating prices between their own companies and using them as tax write-offs. It's also known as the arm's length principle, and in simple English, you can't just charge yourself ridiculous fees in order to shift profits. So as a case study, if you have two companies, one in the UK and offshore in the Caymans, the tax office is going to compare your prices to independent businesses and what they charge. So if you think you're going to sell yourself a service 10 times the market rate, you're just going to compare what other businesses and the local market prices are. If you think you're going to pay yourself out a massive salary, again, they'll just check what other professionals in that field are earning. And all of a sudden, to tick all those boxes becomes far more costly, far more complicated, and harder to account for. Now here's where most people trying to fake invoices by themselves trip up. Because everything is digital now, there's always a chance that a small detail does not add up. And when the numbers don't match your financial statements, balance sheets, banking statements, or receipts, guess what? That's a red flag for any tax authority. And the more fake invoices you generate, the harder it is to keep that structure airtight. So what do the wealthy and the rich do instead? Well, instead of fabricating transactions out of thin air, they use half-truths. Basically, transactions that have a basis in reality but are structured to their advantage. Instead, they rely on flexible accountants. They're not just number crunchers. They are experts at shaping this paper trail, and these accountants, they will ensure that the invoices are commercially justified, that agreements will hold up under scrutiny, and that the financial statements tell a cohesive story. Allow me to give you a simple example. A lot of people, they buy their car in the name of the company. It becomes a business expense, so you can reduce your taxes, but sometimes you take your family out to the beach on a Sunday with it. Now, if an auditor ever questions it, there needs to be a documentable link between that trip and a business purpose, such as a board of directors meeting. The same thing applies to business dinners. You can write off as many of them as you want, but there needs to be a plausible reason, an explanation for it, such as meeting a client. Now, you can take this concept even further. Obviously, instead of owning properties in your personal name, you can use a business for it. Instead of leasing mail servers from a third party, you can bill a monthly database access fee. Heck, even the software that you've developed in-house can generate subscription fees via a business program licensing agreement. The point is that everything needs to be well documented with a plausible paper trail. Now, Trump's team just got lazy. They didn't even draft the loan agreement, which is pretty easy to do, but since he's the president of the United States, he'll probably get away with it. You are not, so you can't make the same mistake. But the reality is, this is not just a loophole for the billionaires. Structuring loans, adjusting expenses, shifting profits, those are all standard practices for regular business owners. Not because they're trying to break the law, but because they know how to work within it. And that's the key difference. The wealthy, they don't evade taxes. They just structure their affairs so they don't have to pay them in the first place. And the end goal, it's to be as debt-ridden, as poor on paper, while you're actually living a wealthy lifestyle. You want to sever that chain between you and your assets while staying fully compliant with all legal and financial regulations. Anyway, for a deeper dive on this subject, you might want to read Ian Griffin's book on creative accounting, 2 + 2 = 5. It's a very good book. That's it for today's presentation, guys. If you enjoy this type of content, as always, you can like and comment down below, share it with a friend. It does help with the algorithm. I made a previous presentation on how you can use one of these wealthy techniques, which is life insurance, to create that paper trail for your crypto cash outs. All tax-free, it perfectly ties in with this video. I'll be seeing you though next time. Until then, bye-bye.